Hey, it's Dr. J. I am here, students, for you to do another video lecture on Chapter 2. And I apologize for not getting it sooner, but had to work out some technical schematics. So anyway, so Chapter 2 is on economics, okay? We're just going to jump right into this. So Chapter 2 is the framework for business, and which is economics. And it starts off by talking about the navigating a crisis. So navigating a crisis is really important because within the last 5 or even 10 years, we've seen huge catastrophic economic crisis. And the one that stands out the most to me is the housing crisis. So the housing crisis was so extreme because it affected not just the United States, but it affected other economies around the world. Doing things like taking mortgage-backed securities and, selling them to certain trademarks or things like that that were basically worthless because the financial backing behind the actual mortgage was not beneficial because the consumer couldn't pay for it. Okay, so in a nutshell, it was kind of like you had a house, I have a house, and some other people have houses. And all of our mortgage were kind of smashed together and cut up into pieces and given out to different industries, okay, for investment opportunities. But that wasn't a good investment opportunity because the consumer couldn't pay for the mortgage. So it's kind of like getting financed for $500,000 worth of home when you can only pay for $150,000, and ultimately, eventually, you're either going to foreclose or your house is going to go into a short sale, which is what happened. There was a lot of foreclosures, there still are, and a lot of short sales. Now, the difference between a foreclosure and a short sale is a foreclosure is still with the consumer, so meaning that you could be in foreclosure and not have your house be owned by the bank yet. So you still have some room to try to, help yourself out of the situation. Versus a short sale is straight up, it's at the bank. Your home is owned by the bank owns it, the bank has the mortgage back, and you no longer have the home, okay? Which affects your credit report as well. So I thought that was a really good economic crisis to work with for this particular chapter. All right. The housing price index. So the housing price index kind of goes hand in hand with what we're talking about because the housing prices were inflated based on the actual income of the consumers. Okay. If you only make $15,000, $20,000 a year, then how can you afford a home for $250,000 a year? That mortgage is insane. It's not even feasible. And what was happening, it was banks were just literally giving people, financing for whatever amount of home that they wanted for that particular area with no kind of repercussions for if the person could actually afford it or not, okay? Which tailspinned into a lot of people, like I said, having foreclosures and short sales. All right. Managing the economy through fiscal and monetary policy. So fiscal and monetary policy is really important because it helps keep our economic markets structured. Okay. When the monetary policies fail, the economy fails. And that's basically what happened with the housing crisis is the monetary policies that were supposed to be put into place to make sure people were not getting more into debt than they could handle. Those policies were not being enforced and they were not being, put into place where they should be put into versus the fact that they were just giving people approval for home applications. All right. Which goes into the debt ceiling. So the debt ceiling is really important because it is how we are going to pay for the future. And unfortunately, it's something like $1 trillion right now in debt. It's really important to remember that, when we were kids, we used to say, I bet you $1 trillion that, you won't jump over that puddle or whatever. And it was a fictitious word. Now, a trillion is a real word. A real word. And a real word in reference to debt. So it's not even a positive real word. It's a negative financial word. Okay? You can't even be a trillionaire. You can only be a billionaire. So that's a really interesting segue to the federal government revenue. So the Federal Reserve is the big bank. Okay, the big bank controls interest rates, controls the value of the dollar, controls the value of gold, controls the economy. Okay, that's the Federal Reserve Bank. Now, it's really important because the Federal Reserve Bank is a larger bank of the corporation FDIC. So FDIC is the Federal Deposit Insurance Corporation. Okay, they are the federal mandated corporation that helps influence monetary policy for banks. Okay, so when you see that little sticker that says FDIC insured, you should feel secure of, oh, my money is safe. Well, to a certain degree, because if you have a $500,000 in a bank account, whether it's a checking account, whether it's a money market, or any other, checking type account. Now, you're thinking, well, FDIC said that my money is insured, $250,000. And that's exactly true. You're insured up to $250,000. So if you have $500,000 in your checking account or money market or whatever, and something happens to that bank and it goes belly up, and you're at the bank the next day, like It's a Wonderful Life. If you've never seen that movie, you got to watch It's a Wonderful Life. It's one of the greatest banking movies that describes what happens in the banking industry when economic policy fails. I recommend it. So anyway, if you go to the bank and you're like, hey, I heard this bank is going belly up, it's getting ready to close, I want my money. I want all $550,000 or $500,000. And they're like, oh, well, sorry, our policies have already failed, the bank's already closed. FDIC will only insure your money for $250,000 because it's your responsibility to understand that when they say we insure you for $250,000, that means in $250,000 increments. Okay? That's really important to understand. That was probably one of the most vital pieces of knowledge I got when I was working at FDIC. I thought it was wonderful. I think everything happens for a reason, especially when you're in a professional situation to grow your knowledge. So make sure you do that. All right, so monetary policy. Monetary policy, and when you see in the book, it talks about commercial banking. So with commercial banking, the reason why monetary policy is so important is because the banks make money off of your money, okay? It's debits and credits backwards. So when you have money in a savings account or in a checking account, let's just say checking account to make it simple. If you have money in a checking account, okay, that is an asset to you, but is a liability to the bank. Because with checking accounts, you're always using it, okay? So that's why they're always pushing, well, why don't you open a savings account? Why don't you open a CD? Well, why don't you open a money market? Because with a money market, unless it's changed, you need a minimum of $5,000 to open up a money market, meaning that you have got to keep $5,000 in the account at all times, which means they're using that $5,000 and they're diversifying it. They're giving it to other people, not literally giving your money away, but financing it out so that way they can make more money on it, okay? So that's really important to understand. Whatever is an asset to you, it's a liability to the bank. If it's a liability to the bank, then it's an asset to you. Okay, so whatever it is to you, it's the exact opposite for the bank and vice versa. Okay? All right. Okay, so then we're going to go to FDIC. So FDIC, like I said, is the Federal Deposit Insurance Corporation. And it works in a couple of different ways. They don't just only insure the money. I mean, that's their mission goal. But what FDIC really does is they help banks. They ensure compliance with banks. They help banks ensure that policies, regulations, compliance, anything else in reference to consumer markets are being upheld. But it's not just FDIC, okay? It's also private and public and state examiners. So that's all FDIC is an examining unit, meaning that they're literally examining the books of the banks. So they go into the bank, they're there for about 2 weeks. I know because I did this, and we go bank to bank to bank every 2 weeks, reviewing policies, procedures, managerial items, all these things. Okay, so that's really important to understand. Oh, and a bank cannot function without FDIC insurance. So just because a state examiner and a paid, private for examiner says, oh yeah, your books are good, the bank's good, yeah, keep functioning. If FDIC comes in and says, these books are cooked, they're bad, the bank cannot function, and it closes down. Normally they get some kind of warning, but if they've had a warning before, then the bank can literally be closed down during that examination session. I know because I've seen it, and it's pretty intense. All right, so we're going to go to the supply and demand curve. So the supply and demand curve. There's always going to be a supply, and there's going to be a demand. But the equilibrium is what's in the middle. What's going to be the perfect supply and the perfect demand of a product. That's what businesses really focus on, is the perfectness of the product and the supply and the demand, which goes over to productivity, because they can't produce anything without understanding what their supply and demand is. All right? All right, gross domestic product. So the gross domestic product is super important because it measures the total value of the final goods, okay, and services produced. So if it's measuring the products of, or the total products of the goods and services, then that means the goods and services need to be of good quality, okay? And in order for the business to make a profit, it should be manufactured in a way where they're making at least, I don't know, more than half or 3/4 of whatever they would make while they're producing it, which is why a lot of times businesses send their productions overseas, because they could get cheaper labor when they send it overseas and then make a larger profit. Not saying that's ethical in all cases, not saying it's not ethical in all cases, just saying that it's a fact of business. All right? Okay, and then finally productivity. So productivity, like I said, is the end result of the supply and the demand curve, and then the equilibrium inside what that supply and demand is going to be based on the quality of the product. And I also wanted to mention pure competition, and monopolies overall. So competition is really important because without competition, a business can't grow, all right? The pure competition is based on, the exact same product, the exact same services in the exact same area, dealing with the exact same customer. Pure competition. Monopolies, meaning that, one particular business has a leg up on one particular industry, okay? So for instance, let's take soft drinks, for example. So Coca-Cola is a predominantly popular soft drink, and some would say it would dominate the field, but technically it has, plenty of competition. There's tons of competition out there between what you want to purchase and what you want to buy, and the quality of the purchase of the products as well. So it's really important to understand that just because a particular product is popular does not mean it has a monopoly on that particular market. Okay, wanted to outline that. All right, so that was chapter 2, economics. If you guys have any questions, comments, or concerns, please feel free to call me, email me, or stop by my office. I am here for your success. I'm Dr. J, and I hope you enjoyed chapter 2, economics. All right, guys.